What if I told you that a fast food restaurant sitting on the corner of some random suburban intersection could actually be a safer, a more predictable financial asset than a government bond?
It sounds crazy when you put it like that.
Right. Because when you drive past a Taco Bell or, a local oil change shop,
Yeah.
you probably just see a place to grab a quick lunch
Mm.
or get your car serviced.
Yeah, you just see the physical building, the concrete, the glass, the drive-through window.
Exactly. But when commercial real estate investors drive past those exact same buildings, they see something completely different. They see an invisible, highly calibrated wealth machine just humming right there in plain sight.
It really requires a complete shift in how you view the world around you because those bricks and mortar, they're really just the outer shells.
Yeah.
What's actually inside is a very specific, meticulously crafted set of legal agreements, tax strategies, and risk profiles, all designed to generate passive income.
Okay, let's unpack this, because our mission today is to give you a shortcut to understanding those hidden mechanics without you having to spend the next 5 years reading dense financial reports.
Which nobody wants to do.
No, nobody wants to do that. So we are taking a deep dive into a highly curated commercial real estate newsletter from the Eureka Business Group, or EBG. This specific dispatch is dated July 11th, 2026.
And just for context, EBG is a major advisory firm based out of the Dallas-Fort Worth area. They've been active in this space since 2008, led by Joseph Goslin.
Right, and today we are going to decipher their inside perspective on the single biggest question in real estate right now, which is it the right time to buy?
The million-dollar question, literally.
Literally. And even more importantly, we're going to analyze exactly what kinds of properties the experts are targeting in this current market to build true generational wealth.
If we connect this to the bigger picture, looking at the single, highly detailed newsletter gives us a massive macro view of the 2026 commercial real estate landscape.
Because we aren't just looking at a random list of properties for sale.
Exactly. We are analyzing a curated philosophy of how smart capital is moving in a very specific economic moment. We really can't judge the individual properties on this list without first understanding the rule book that EBG is playing by.
That makes total sense. We have to understand the philosophy before we look at the actual investments. And EBG tackles that big looming question right out of the gate on page 1. Is it the right time to buy?
And their answer is a very highly qualified yes, but, with a big emphasis on the but.
Let's start with the yes part.
Sure, so the yes part of that answer is heavily dependent on historical context. The newsletter notes that the current market is definitely favoring buyers today.
Okay.
Now, interest rates might be a bit higher than the sheer almost 0% anomaly we got used to over the last few years.
Which is just crazy.
Oh, totally unprecedented. But from the overall perspective of market history over the last few decades, these rates are actually quite normal.
Right, and EBG mentions that this specific environment creates a historic opportunity to buy at higher capitalization rates, or cap rates, than we've seen in decades.
Yeah.
Now, I see that term constantly in real estate literature, but how does a cap rate actually apply to a physical building we might invest in? Like, break that down for me.
Think of a cap rate as the raw, unfiltered yield of a property if you just bought it in straight cash.
Okay, cash.
It is the net operating income, so the rent you collect minus the operating expenses divided by the purchase price. So if a building generates, say, $100,000 a year in pure profit and it costs $1 million to buy.
That is a 10% cap rate.
Exactly, 10%. In a market with slightly higher interest rates, property prices often soften a bit, which pushes those cap rates or potential yields higher.
Okay, I see.
That is the yes part of EBG's answer. Buyers today can lock in higher yields.
That sounds like a golden opportunity, but you mentioned a but. EBG's yes, but.
Right, and this is the crucial part of their philosophy. The advice from EBG is absolutely not to just blindly chase the highest cap rates you can find.
Because higher isn't always better.
Far from it. A very high cap rate is almost always attached to a much lower quality asset. The underlying strategy they are pushing is to look for historically high cap rates offered for quality assets in great neighborhoods.
Specifically with national brand tenants.
Yes, exactly.
That distinction really changes the approach. It's like chasing a high cap rate on a bad property is like buying a cheap, totally unreliable used car just because the monthly payment is low.
That's a great way to put it.
I mean, sure, the math looks incredible on paper on day one and you're getting cash today.
Yeah.
But when a massive repair comes up, or when that obscure local tenant goes bankrupt and stops paying rent,
It completely flattens your entire portfolio. You lose everything you gained.
is a higher cap rate always a siren song, or is there ever a time to take the risk?
Well, it all comes down to risk mitigation. A high cap rate on a sketchy property with a tenant no one has ever heard of is just a gamble. It's a roll of the dice.
Right.
But a slightly higher than average cap rate on a property with a national tenant, say, a corporate-backed auto parts store in a booming neighborhood, that is a calculated, protected investment.
Because national brands just have more padding.
Yeah, they have corporate backing, incredibly predictable business models, and the capital reserves to actually weather economic storms. Plus, being in a great neighborhood ensures that even in the absolute worst-case scenario where the tenant leaves, the underlying dirt is still highly desirable to someone else.
So the location saves you.
Exactly. Those two factors dramatically mitigate the risks usually associated with higher cap rates.
So what does this all mean? Well, EBG actually shifts gears in a really surprising way next. They point out that this specific market, with these specific conditions, isn't just ripe for the traditional real estate investor sitting in a boardroom somewhere.
No, they see a massive opportunity right now for everyday business owners.
Yeah, the owner-user advantage. EBG highlights this unprecedented window for business owners. I mean, everyone from local physicians to retailers, service providers to manufacturing companies to actually buy the vacant buildings that their businesses currently occupy or could occupy.
The mechanics they describe here are wild. The newsletter mentions that up to 100% financing is available with certain loan programs right now.
Wow.
And because it is a buyer's market, sellers are highly motivated to move these vacant buildings at great prices.
Now, before we go any further, I need to pause our analysis for a brief moment because the newsletter explicitly mentions that part of this opportunity is fueled by, quote, massive tax benefits created by the recent big, beautiful bill.
Right.
And we want to be incredibly clear with you, the listener. We are taking absolutely no sides on this politically charged legislation.
None whatsoever.
Whether you lean left, right, or center. Our job today is simply to impartially report on the content provided in our source material. We're just conveying the original source's viewpoint that the newsletter claims this specific bill creates tax benefits for business owners, and we are not endorsing the viewpoints of the content.
Exactly. We are strictly analyzing the economic chessboard exactly as EBG sees it. And looking at that chessboard, the transition from being a tenant to being an owner-user is one of the most profound financial shifts a business can make.
It reminds me of residential renter finally scraping together a down payment and buying their first home. You know, you stop throwing your hard-earned money into a landlord's pocket every month and start building your own equity.
It's the exact same principle.
Except in this case, we are scaling that concept up to a massive manufacturing facility or a multi-doctor retail medical clinic.
Yeah, if we look at the underlying mechanics of that transition, it fundamentally changes a business's balance sheet. When you are a tenant, your rent is a pure liability.
Just an expense.
Right, an expense that disappears into the ether, and you are entirely subject to market spikes every time your lease comes up for renewal. But when you become an owner-user, you lock in your facility costs.
Your mortgage payment is actively paying down debt.
And building equity. You gain the potential appreciation of the commercial asset itself. You secure your operational future without the constant looming fear of eviction or massive rent hikes.
Which turns a sunk cost into a tangible asset on your ledger.
Exactly. Which dramatically increases the overall valuation of the company itself.
Okay, so we've established who is buying and the philosophy behind why they are buying. Let's start looking at exactly what they're buying. We can see these strategies play out in real life by looking at the entry-level tier of EBG's listings.
Right. These are properties under the $3 million mark.
This is where the abstract philosophy meets the concrete pavement.
And instead of just listing off numbers, what's crucial to notice here is how EBG curates vastly different risk profiles within the exact same price bracket.
The variety is staggering, actually. On one end of the spectrum, you have an exclusive listing for raw zoned commercial land in Fort Worth, near a super high traffic area, like over 104,000 vehicles per day. But it's just dirt.
Just dirt. Raw potential.
Then you pivot to a 12,000 square foot retail center, also in Fort Worth, that recently had a new roof put on. EBG explicitly calls this a value-add lease-up.
Which means the building exists, but it needs a buyer willing to go out and find tenants to fill it.
Right. And finally, on the completely opposite end of the spectrum, you have a fully operational single-tenant Long John Silver's in Texarkana.
Yeah.
Wait, hold on a second.
Oh.
Raw dirt that needs to be developed from scratch versus a fully functioning fish and chips restaurant that EBG says has an absolute NNN lease? Why are these even lumped together in the same tier? They seem like totally different sports for an investor to play.
What's fascinating here is they are different sports, but they require roughly the same amount of capital to enter the stadium.
Oh.
EBG is offering the investor a choice of how hands-on they want to be. To understand why that Long John Silver's is so appealing compared to the raw land, we have to unpack that term you just mentioned, the absolute NNN or absolute triple net lease.
Yeah, I see NNN all the time, but what are the actual mechanics of it? What does it mean for the person who buys the building?
Okay, so in a standard residential lease, if the toilet breaks or the roof leaks, you call the landlord, right? And the landlord pays to fix it.
Right.
In an absolute NNN commercial lease, the tenant is financially responsible for absolutely everything. Property taxes, building insurance, and all maintenance.
Wait, all maintenance?
Everything, including the roof, the structural walls, the parking lot, everything. It means zero landlord obligations.
Oh, wow.
Yeah, if the HVAC system completely dies, the tenant pays to replace it. You, as the investor, simply check your bank account every month to make sure the rent cleared.
So it's essentially a mailbox money scenario.
It is the ultimate form of passive income in real estate. And EBG pairs that passive structure with another massive strategic advantage, the out-parcel positioning.
Right, the location.
That Long John Silver's is an out-parcel to an Albertsons grocery store, and it sits right across the street from a signalized Walmart corridor.
Ah, so they are intentionally buying properties in the gravitational pull of massive retail giants.
Precisely. Walmart and Albertsons don't guess where foot traffic is going to be. They spend millions of dollars on data analytics and site selection to guarantee traffic.
So they do the homework for you?
Exactly. By buying an outparcel in their orbit, you are essentially drafting off their massive research budgets. You guarantee visibility without having to generate the draw yourself.
That is incredibly smart.
So in this entry-level tier, EBG basically asks the investor, do you want to take a massive risk developing raw land? Do you want to roll up your sleeves and hustle to find tenants for a half-empty retail center? Or do you want to sit back and collect checks from a fast food joint, basking in Walmart's glow with zero maintenance responsibilities?
Here's where it gets really interesting. Because as we move up the price ladder into the mid-tier sweet spot, properties between $3 million and $7 million, that strategy of national brands and zero landlord responsibilities completely takes over.
Yeah, EBG's list in this tier is heavily dominated by these absolute NNN leases. But they add a new layer, corporate guarantees.
They're scaling up the stability.
When you move into this price bracket, you are looking for absolute certainty.
And you can see it in the assets they target. Instead of listing off a dozen different square footages, let's look at the underlying strategy binding them together. EBG lists an Advance Auto Parts in Richmond, a Taco Cabana in Dallas, and a Quick Car Oil Change in Plano.
And again, we see that same positioning. They're all out parcels to major giants like Walmart, or they sit on highly trafficked, dedicated thoroughfares.
But there's a specific detail on that Quick Car lease that really stands out. EBG notes it features annual rent bumps via CPI.
Yes.
That sounds like an incredible deal. It's like a salary that automatically adjusts for inflation every single year without you ever having to go into your boss's office to negotiate a raise.
That's a great analogy.
Why is that specific lease feature considered the holy grail for investors right now?
Well, this raises an important question about the nature of money itself, especially in a fluctuating economy. Inflation is the silent killer of fixed income investments.
Definitely.
If you buy a building and lock in a flat rent of, say, $10,000 a month for the next 20 years, the actual purchasing power of that rent check gets eaten alive by inflation over time.
Because things just cost more in year 20.
Right. $10,000 in year 20 buys a fraction of what it buys in year 1. But when you have a lease with annual rent bumps tied directly to the Consumer Price Index, or CPI, your income automatically rises exactly as the cost of living rises.
So it's an automatic defense mechanism against economic shifts.
It is. And when you pair that CPI inflation protection with an absolute NNN lease where you have zero maintenance costs and you add a corporate guarantee backing the rent, the dynamic changes entirely.
Let's talk about that corporate guarantee, actually, because I think a lot of people assume that if a local fast food franchise goes out of business, the landlord is just out of luck. Like the store closes, you lose your rent.
In a standard lease, yes, you'd be in trouble.
Yeah.
But a corporate guarantee is a legal firewall. It means that the parent corporation, the massive entity sitting in a high-rise headquarters somewhere, is legally obligated to pay the rent for the entire duration of the lease.
Even if the local guy fails.
Even if that specific local franchisee goes bankrupt and closes the doors. When you combine the zero maintenance, the inflation protection, and the corporate backing, you effectively turn a physical piece of real estate into a hands-off inflation-protected bond.
Oh.
It behaves more like a fixed-income financial instrument than a physical building with a roof and a parking lot.
And EBG doesn't just stop at standard retail in this mid-tier. They showcase an incredible eye for secondary angles, They list an Osaka sushi restaurant on a dedicated restaurant row in Addison. But the real hook isn't the sushi. It's that the lot has enough excess space to build an entirely new building right next door.
So there's hidden physical upside.
Yeah. They also highlight a facility leased to Circle of Care in Schertz, which is a regional therapy provider. But the detail EBG emphasizes is that the tenant is backed by private equity.
Right.
It shows that an advisor like EBG isn't just looking at the current rent, they're looking at the financial firepower of the entity signing the check, or the dirt itself. They also mention some flex options, like industrial space in Roanoke with short-term leases for owner users, or mixed-use land in Mesquite.
It's a multidimensional approach to value. You have the primary passive strategy, but you always want an alternate lever to pull if needed.
Which brings us to the heavy hitters, the $7 million plus tier. We've established how a single tenant, like an auto parts store, can basically run on autopilot. But what happens to the risk profile when you multiply that by 20?
Oh, the scale completely changes the nature of the investment.
Right, because you aren't just buying a single building. You're stepping into this top tier to buy a massive economic ecosystem.
You are no longer just relying on one corporate guarantee. You are managing a complex web of overlapping lease terms, tenant health, and market dynamics.
Case in point, EBG lists a massive, almost 57,000 square foot retail center in Keller, Texas. This isn't a standalone drive-through. It's anchored by two major national credit tenants, Sprouts Grocery Store and Michael's Craft Store.
In a highly affluent trade area, too.
Right. But the crucial detail EBG makes sure to point out is that this center currently has below-market rents, with contractual rent bumps coming in 2027 and 2028.
That phrase, below-market rents, is an immediate signal to a sophisticated buyer. You are looking at an asset that is currently underperforming its true potential, with a guaranteed path to increased revenue already legally baked into the existing leases.
But then we get to a listing that legitimately made me do a double take. It's an industrial complex in McKinney, over 47,000 square feet. It's a newer build from 2022. It has roughly 25 different suites, and it is currently 100% leased out at a 7.45% cap rate.
That sounds amazing on paper.
It sounds perfect. But EBG notes a highly specific detail. Almost 89% of the square footage rolls over, meaning the leases completely expire within 2 years.
Yes.
Wait, a mass exodus of tenants in 24 months?
Okay.
How is that a selling point? Having nearly 90% of your tenants potentially pack up and leave sounds like an absolute nightmare. I would be terrified.
Well, if we connect this back to the broader strategy they laid out on page 1, this is the ultimate value-add opportunity. Yes, it requires critical thinking to spot the pattern here. Remember, EBG noted at the very beginning that we are in a market favoring buyers and that we have seen significant shifts in the economy.
Okay.
If you have an industrial complex in a booming economic area like McKinney and the property is completely full, it means tenant demand is incredibly high. Space is at a premium.
Right. You can't find space anywhere.
Exactly. Now, if those 25 leases were signed several years ago, the rent those tenants are paying is likely far, far below what the current 2026 market actually demands. Now, in commercial real estate, the value of a property is heavily dictated by the income it produces.
So if the rent is low, the building value is lower.
Yes. If you buy a property where the leases are locked in for the next 10 years at an old, cheap rate, you can't touch that revenue. You are stuck. You can't force the value up because the income is capped by the old lease.
Oh, I see.
But if nearly 90% of the leases expire in 2 years, a new owner has the immediate ability to renegotiate or sign new tenants, bringing all of those rents up to the current, much higher market rates very quickly.
Wow. Okay.
It's not a warning sign of an exodus. It's a massive lever you can pull. By aggressively raising the income of the property to market standards, you force the overall valuation of the building to spike dramatically.
So it's a lot more work.
It's a much more active, hands-on investment than the Long John Silvers, but the financial upside is tremendous.
That completely flips the script on how to view an expiring lease. It's not a threat, it's a tool for aggressive appreciation. And, as we bring all these tiers and strategies together, looking at the firm providing this data actually tells us a lot about the industry itself.
It really does.
EBG's value proposition isn't just about handing you a catalog of buildings for sale. The newsletter clearly outlines that their real work centers on advising on the complex decisions that actually shape these outcomes.
Right. They highlight their services in lease level review, property operations, and ownership decisions where lease structure, tenant quality, and market timing all have to align perfectly.
Because real estate at this level is never just a transaction. It's a highly strategic, ongoing operation. Execution matters just as much as selection.
Absolutely.
They even include a prominent link in the newsletter for a 1031 exchange timeline calculator that their team created. I hear the term 1031 exchange thrown around all the time in wealth building circles, but how does that actually play out in these scenarios?
A 1031 exchange is, frankly, one of the most powerful tax deferral tools in the United States tax code.
Hmm?
Essentially, it allows an investor to sell an investment property and defer paying any capital gains taxes on the profit.
Just skip the taxes entirely.
Defer them as long as they reinvest those proceeds into a new like-kind property. You can essentially swap properties and roll your gains forward indefinitely, continuously building wealth without the IRS taking a massive cut of your principal every time you sell.
So you could sell that risky value-add retail center once you've leased it up and roll all those tax-free profits right into a totally passive NNN corporate-backed auto parts store.
Exactly, you trade up. But the catch is the timeline. The IRS mandates incredibly strict, unforgiving deadlines for identifying the new property and closing the deal.
No extensions.
None. If you miss a deadline by even one day, the entire exchange fails, and you're hit with a massive, devastating tax bill.
Ouch.
Yeah, so EBG provides this calculator because navigating those legal timelines is just as critical to wealth preservation as picking a building with a good roof.
The overarching lesson here is that visibility is everything. You, the listener joining us today, can now drive down the street, look at a local taco cabana, a Sprouts grocery store, or an unassuming industrial park, and see far beyond the stucco and the signage.
You see the mechanics now.
Yeah, you can now see the invisible financial engines running beneath the surface. The corporate guarantees providing legal firewalls, the CPI rent bumps protecting against inflation, the strategic outparcel positioning, capturing millions of dollars in drafted foot traffic, and those expiring leases waiting to be pulled like levers for massive appreciation.
It fundamentally changes how you see the economic landscape of your own hometown.
It really does. But as we wrap up this deep dive into EBG's insights, I want to leave you with a final provocative thought to chew on, something that builds on everything we've uncovered today. We spent a lot of time discussing the absolute beauty of the NNN lease, the zero landlord responsibilities, the corporate guarantees, the total safety of mailbox money.
It's the dream for a lot of people.
But if your ultimate goal is truly building massive, life-changing generational wealth, at what point does the safety of a cruise control lease actually start to limit your upside?
It's the classic, inescapable trade-off between risk and reward.
Exactly. If you never have to fix a roof, if you never have to renegotiate a complex lease because your tenant is locked in for 20 years on a flat rate, are you inadvertently leaving the biggest profits on the table?
You might be.
Are the truly massive gains reserved for the investors who are willing to roll up their sleeves, wade into the messy, complex value-add projects, and take the real risks? Next time you drive past that half-empty retail center or that bustling fast food joint, ask yourself, do you want to own the safe, predictable machine, or do you want to be the mechanic who actually builds it?